It has started. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, the greatest threat to American jobs is here. And this is something the political elite said could not and would not happen. And yet we've warned otherwise that this was coming. And it's not just a risk that threatens American workers. It's something that threatens workers all over the world. And it's here now. Let's head over to Bloomberg, where we picked today's story up with a headline. China's property lifeline exposes banks to big losses, and now even job cuts. And this is something we said would eventually happen, that under the threat of reduced earnings and reduced cash flows, that businesses all over the world would be forced to do the one thing that central bankers have been telling us is not an issue, that the labor market around the world remains strong and robust. And we said there's only to a point. And sure enough, we're starting to see that in China. And as we predicted, the banks are under big trouble, far worse than even we thought. Already stung by soaring bad loans and record net interest margins, lenders such as Industrial and Commercial Bank of China may soon be asked for the first time to provide unsecured loans to developers, many of whom are in default or teetering on the brink of collapsing. So again, let's looking back here, we see as we covered this before, you're a bank and your job is to make good loans to people who are likely to pay them back. And as part of your business model, you're well aware there's a small percentage of those people that won't. And if they don't, you're at risk for them. And now the government's coming out and saying, you will have to go lend to all of these companies and you'll have to do unsecured loans. Meaning if they don't pay, you lose. And oh, by the way, all these companies you're going to lend to, well, they're insolvent and not paying on their debt now. This puts the banks in a bad situation. The risky lifeline threatens to exacerbate an already bleak outlook, as 10 other major banks included may next year need to set aside an additional $89 billion for bad real estate debt, or 21% of pre-provision profits in 2024. So keep in mind, when banks set aside money for loan losses, well, that's money they're not lending to everyone else's. So you see the government coming out and say, look, we're going to force you to lend here to people you probably don't want to lend. In fact, we're relatively sure you don't want to lend to them. And instead of lending to other people that you could lend to, that you perhaps might actually make some money on, well, now you're going to have to set aside even more money in loan loss reserves, putting you at even greater risk of collapse. And of course, the banks only had one response to that. And now lenders are weighing lowering growth targets and cutting jobs among possible options, because after all, you've got to cut overhead. And this, according to at least a dozen bankers who were asked not to be named. Well, of course not, because, well, in China, you don't want your name out in the public too much. But yes, this is what naturally happens as we look at the U.S. data here. When you see a contraction in lending, this is what China is trying to starve off. The problem is this is happening all over the world. And as we discussed, when you see central bankers invert money curves and yield curves, banks can't make a profit. They borrow at the short end of the curve and they lend at the long end. So when the short end is higher than the long end of the curve, well, they don't make money. That would like buying a product and selling it at a loss. You wouldn't do that. Well, that's not their business model either. The challenge happens here as we see a constriction in credit throughout not only the U.S. economy, but every major industrialized economy. There's just less money flowing around the system. And when there's less money, well, that means there's less workers needed as well. And here's the evidence as we see the commercial industrial lending data. Again, this is from the U.S. on a weekly basis, shown on a year-over-year rate of change. And I just want to point out that we are indeed in a contraction, as we predicted would occur, and is likely to head even deeper here in the near-term future. But what happens as you see a contraction in credit or a decline? What you'll notice is in the red line, we have the 4-week moving average of initial claims. And as money growth slows down, well, so does demand and so does labor. And here you can see that each and almost every time there is a decline or a significant decline in bank lending or an outright contraction, that means U.S. workers hit the unemployment line. So what we're seeing here in China is at the banking level alone, they're saying, look, we're going to have to get rid of employees. What they don't understand is going outside even further into the broad Chinese economy, there's going to be more layoffs there. And it's not just China. It's going to be the Eurozone, other parts of Asia, all over the world. We're going to see an increase of layoffs in the not too distant future. The government can't just ask banks to step up without providing a solution to their issues. This from a director at a Beijing-based investment bank, Chase and Company. Well, let me give you some news here. They're a communist country. They can do whatever they want, and people will have to follow. That's kind of how it works there. And I know I'm kind of laughing at this a little bit, but that's the issue. The government is putting the banks in a precarious situation that if these loans don't actually materialize into profitable business for the banks, they're going to go under. And that's what we talk about, this global dollar shortage. And this affects not only these property developers, but those banks as well. And our case here is the banks can lend all the money they want to these insolvent developers. It's not going to work. In fact, it's only going to make the impending financial crisis in China much worse. And now let's head over to the UK, where inflation falls to the lowest level in 17 months. Of course, we keep hearing inflation is a problem, but not so much now, as the British Retail Consortium said Tuesday that inflation fell 0.9 percentage points in November to 4.3%, the lowest level since June of 2022. And on top of that, it's the sixth straight month that the trade association has recorded declines. However, the lobby group said there was no guarantee that inflation would keep falling, with higher taxes and an increase in minimum wage pushing up costs. And all this is leading to is a decrease in demand, something that we've made the case for as retail sales growth slows. And yes, prices could stay elevated due to taxes and other things. Yes, that is a real scenario here, that higher labor costs keep inflation from falling fast enough. The problem occurs, this happens to all of us. We go to the store to buy something, we pick it up, we look at the price and say, you know what, maybe I don't need this right now, and that leads to less demand. And it could be that maybe people do need it, they just can't afford these higher prices. Of course, we've made that case all along. And retail sales fell unexpectedly last month. Of course, that means central bankers are clueless to how the monetary system works, stoking fears that the Bank of England's restrictive monetary policy is starting to weigh on economic activity. And as we've made the case in the past, this all leads to more and more unemployment. And yet, that's something the central bankers can't see. But one thing that shouldn't be unexpectedly tumbling, well, that's your trading account. Many people ask me, Steve, can you make money in any type of market with your reports? Well, the answer is yes. Let's do an update on our recent call on gold. Now, you remember we picked this up near the bottom. We had a nice gain on it. We got out of that trade, and now we're back. This as of November 17th. And what did we look for? The machine positioning reverse after that pullback where we were stopped out of our trade. We had that on our list of things to watch. We saw that here on November 17th. This is our machine positioning report. And this is critical because the machines drive the market in such a rapid pace. If you know the machines are moving along, you want to trade with them or ahead of them. That's what a report does. Or you want to get out of the way when they're selling. And one thing then we were waiting for, which we got also confirmation on November 17th. Now, this is what some of our most successful traders do. They use both reports in tandem. They wait for confirming signals because our Momentum Timer Pro looks at those technical signals. Here you see gold on November 17th, giving us one of those daily buy signals. And this thing aggregates all of those weird technical things like the RSI, the MACD, the STOCH, and all those other signals that many people struggle with. Well, we smooth that all out for you. Put in the daily signal. And this would have told you to buy it open on this little red candlestick here on November 17th. And yes, it went down for a couple days, but that little trade's up 2.4%, looking to even go higher as we record this show right now. And so that is pretty impressive. I will put a link to both of those reports in the description below that you can access. I'll put 3 coupon codes for a free month, but keep in mind, if you go there to check out and there's no coupon box, that means 3 other people beat you to it. Got to get it quick before they're gone. But one thing that is going to be gone is UK inflation. But just don't ask the central bankers that. As no prospect UK rates will be cut soon, this according to the Bank of England's Haskell. Of course, as we know, these political elites are completely clueless to how the system works. And here you can see that the retail industry say, look, we're seeing a slowdown. Inflation's coming down, but we have some excuses of why it may not come down further. Well, what's going to happen is if prices don't drop faster, demand is just going to evaporate and they will come down. And even quicker because labor costs will go down. When companies start to lay off people, this will happen. But let's take a look what Haskell had to say. In the text of a speech due to be given at the University of Warwick later on Tuesday, Haskell said it was not true. Keep in mind, not true, he says, that with inflation falling, interest rates can be cut sooner rather than later. He added the UK labor market remains historically tight. Well, Haskell, I got some news for you. The labor market is not going to remain tight for a whole lot longer because we just looked at what's going on in China in the banking system. We're now seeing retail sales growth slow there, and we know historically that leads to layoffs. But with inflation falling, well, we know what that means. That means the labor market says demand is coming down, demand goes away. Well, you don't need as many workers. Here, back to the U.S. data, we've got the Consumer Price Index. We'll stick with our theme of the 4-week moving average of initial claims. That's shown in red. And what do we know? Even back in the 70s when inflation was a problem, you noticed that when people started losing their jobs, inflation eventually came down. You saw that again here in going into 1975. That happened a second time. And just when people said inflation couldn't be kept in a bottle, well, sure enough, the labor market said, hey, if you put enough of us out of work, demand goes down. But now more in modern times, when we move into a global economy, look at what happens. The labor market starts to show signs of weakness when inflation gets too hot. People can't afford prices, and lo and behold, inflation comes down. And notice it gets more and more in sync as we head over to the dot-com bubble. And then the global financial crisis, remember, that was dominated by energy prices, driving consumer prices higher. The labor market couldn't afford it because wages didn't keep up. And of course, that meant inflation come down. We're seeing the same thing happen here again. And yet one thing that's causing a problem with inflation is our friends over at OPEC Plus, as talks are his stalemate on Africa oil output quota dispute. And we continue to make the case here that, labor around the world faces 3 main issues with their income. They've got housing or rents. Now, if you own your home, that payment hopefully is fairly stable and you're not taking out more debt. If you have rent, if you're paying rent, well, we know those prices have gone up, but based on things I'm seeing, that's starting to stabilize as more rental units come online. But energy, very variable component of the consumer price index, and this has caused consumers to have an issue with their discretionary spending. And our case to OPEC is you need to pump more right now. You need to flood the market with supply, drop prices down so the global economy stays out of recession, and then you can raise prices later by constraining output. But at the moment, because you're trying to drive prices higher, it's not working at all. And with fundamental softening and market sentiment bearish, OPEC Plus may need to announce another formal cut. This from some analysts. Anything short of a 1 million barrel a day reduction, they say, could send prices to the low 70s. And you want to talk about deflation coming, because we know where oil prices go, gas prices follow. And the key part of what they said is with fundamental softening and market sentiment bearish. And so that means they're starting to see signs that the global economy is weakening. So it doesn't matter that OPEC is trying to constrain supply here, because they did exactly what we said would happen. They would try to drive prices up. They cause discretionary spending to go down, and that means in the end of the day, you don't need as many products being manufactured, you don't need those products moved to the stores, and people aren't going there to buy them. That leads to lower oil prices, and that is where we're headed with this big threat to the U.S. labor market that shouldn't happen. Well, it's all about demand, and of course, the U.S. manufacturing sector. Let's look now as we have the U.S. consumer confidence increased in November. This from the Conference Board, saying the index bounces back after 3 straight monthly declines as expectations, I love this, turn less gloomy, meaning people are still not that optimistic, but they're only slightly more not optimistic, which is actually a good sign. But let's take a look at what's going on with consumers, because as we look ahead, where consumers think the economy is going, their spending matches. So if their outlook gets better, they spend more. If it stays gloomy, they spend less, causing that, again, that feedback loop of less demand leads to higher unemployment, which is less demand and further higher unemployment. Consumer expectations for the next 6 months recovered in November, reflecting improved confidence about future business conditions, job availability, and incomes. Of course, we can make the case that none of those things are going to actually occur. Business conditions are going to get worse. Job availability is going to dry up. And incomes, well, as you're going to see here in a little bit, those are going down as well. But yet, compared to last month, expectations that interest rates will rise in the year ahead had ticked down. But consumers' outlook for stock prices continued to weaken in November, despite the fact that we've showed you that due to machine positioning and corporate share buybacks, well, they're rallying. But notably, look down here as we see buying plans for autos, homes, and big-ticket appliances trended downward on a 6-month basis, perhaps reflecting the impact of elevated interest rates. Of course, if consumers are getting a little more confident, then you think they go out and spend. And this is where as we're getting into what's going on in the U.S. manufacturing sector is something we predicted. This was a huge threat to the U.S. labor market. It's starting now. And notably, so I wanted you to see what Bank of England had to say about interest rates. And of course, we know what the Fed's going to likely say in a couple of weeks. They're going to say we need to keep them elevated. Well, but not for much longer. Because here we can look at crude oil prices, this against the University of Michigan consumer sentiment, and we can see there are periods indeed, of course, as you go into recession, where oil prices are rising. Here you can actually see them here in the 1990s. I didn't highlight this one, but you can know higher oil prices spike. Confidence comes down because it eats into discretionary spending. You see that going into the dot-com bubble. Again, higher oil prices, wages aren't keeping up, confidence falls. You see that during the global financial crisis. This one obvious. And then here it is now. You see, of course, all this demand to drive energy higher because the global economy is supposedly going to recover and boom. Turns out that wages were not recovering and booming despite high inflation. Confidence goes down. As oil comes down, confidence starts to rally up. But we're getting to the point where now we need to see oil drop considerably because inflation still running ahead of total compensation. Consumers here in the U.S. are in dire shape, and this is all flowing back to manufacturing. So now as we look at demand, we have some early data on Cyber Monday, not as good as we needed it to be. As Cyber Monday sales hit a record $12.4 billion, even as savings dwindle, there's a key point. We know that U.S. consumers are tapping their savings, but it's not just the only thing they're doing. We touched on this in the show yesterday, that consumers are making a big mistake. This is going to have major economic implications going into the next year because it's further going to constrain spending, as we're about to see. Spending increased 9.6% from a year ago, making it the biggest online shopping day ever. This according to Adobe. Keep in mind, this is a taller amount. This was expected. And what did we talk about last week? That we need to see 13 to 14% growth. That's kind of the norm. And what are we seeing? 9.6%. You take off inflation of around, say, 3%. You're down to a little over around 6.5%. You're still not seeing very impressive growth here at all, despite the fact we did hit a record day. And we note that this happened backed on stronger than expected spending on Black Friday and the popularity of one of the biggest problems as we're going to face next year. Well, that's buy now and pay later. Forget your credit card. You don't need that anymore. The retailers are going to do this for you. You can have it today. You got to pay us tomorrow. So you think about what's happening here is consumers are pulling forward demand into next year. But that's not just the issue. The issue will be this will be a payment that they have to start making next year over a set period of months. And one of the challenges is we're making the case that the labor market's about to fall apart. And of course, those payments will still have to be made, meaning less discretionary spending, more employment coming. Buy now, pay later usage also hit a record high on Cyber Monday, because what I'm saying is not a good scenario, contributing $940 million in online spending, up a whopping 42.5% over the previous year. The firm said the consumers use such credit facilities for increasingly large purchases. So here we see again, up 42.5%. You want to talk about households not in a good shape? Wait till the unemployment claims rise. And as you're now about to see, it's coming because it's not just happening. Well, it started. The S&P Global Flash U.S. Composite PMI, this we picked up last week, as U.S. private sector employment falls for the first time since June of 2020 amid muted demand conditions. And what we said was going to happen, demand was going to fall, and eventually the factories were going to start cutting hours and laying off. And sure enough, we're starting to see it. It started. Here you go. As U.S. companies lowered their workforce numbers during November for the first time in almost 3.5 years, although only fractional, that's where it usually starts, employment tipped into contractionary territory following the first drop in service sector headcount, something we said was coming since June of 2020. Manufacturers, meanwhile, recorded back-to-back declines in staffing numbers. Again, you think about what we're hearing from these political elites like Jerome Powell. The labor market is robust. They're not going to see layoffs. And here they are, just as we said. Business commonly mentioned that relatively muted demand conditions, no shock, and elevated cost pressures led to the layoffs. Other companies noted that hiring freezes were in place amid pressures on margins, just as we predicted. As demand goes down, earnings and revenues fall, margins get squeezed, labor is the next to go. And dwindling levels of unfinished business, also something we cited as a need to have labor around, also impacted hiring decisions as backlogs of works fell for the 7th month running midway through the final quarter of 2023. Goods producers and service providers alike recorded quicker contractions in incomplete business, largely due to a lack of pressure on operating capacity. Or simply translated, we didn't have a whole lot of new orders to work on, so we put all of our workers on these backlogs, and oh boy, they're going away quick. And what comes next? Well, we cut headcount. And now let's head over to the 5th District Manufacturing Survey as what they said here. This from Richmond. The Composite Manufacturing Index decreased from 3 in October to -5 in November, and firms were not optimistic about local business conditions, and most firms continue to report a declining backlogs and vendor lead time as both these indexes remain negative. So again, backlogs go away, labor's next. And sure enough, here you can see as we dig into the report, backlog of orders -23. That's a big number, and notice how it's accelerating between September, October, and November. Number of employees, well, they were adding. Now they're neutral here. What they're not showing us is, of course, the amount of hours worked. But for that, well, we'll head over to Texas because this is an issue. But look at this, price trends. Prices paid, $3.08. On average, prices received, $1.97. Well, there's your squeeze of the margin. That tells you what is indeed coming. Because in Texas, manufacturing slips back into a contraction as activity contracted in November after 2 months of expansion. This according to recent executives in the survey. But look at this. The new order index has been negative for 18 months and dropped from -8.8 to -20.5 in November, telling us whatever's going on in Texas, it is a dire situation. Again, this is all about the fact that the backlogs are running up. And look at what some of the survey respondents had to say. The future is uncertain. There's nothing encouraging on the horizon. Well, that's true. And indeed, that is the risk we're facing because next, as we've seen, is the U.S. labor market. This is a big threat, but it's not just to U.S. workers. It's to workers all over the world. We're headed into a simultaneous economic contraction, and the labor market around the world is the last to go. And as these layoffs start to accelerate, it's game over for the political elites, and you'll watch them. They'll be back at zero on these interest rates before you can even blink. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.